Hello and welcome everyone to the Closing Bell Show, where you can invest with the best. This week we talked with investment expert Vince Martin. Vince has been writing about stocks for over a decade. He's a prolific equity researcher and one of the top financial analysts on TipRanks with a 4.9 star rating. He also writes for his Substack now at Overlooked Alpha. In the chat, we dive deep into Haleon, one of the big players in over-the-counter pharmaceuticals. We discuss the bull and bear case for the company and much, much more. If you're enjoying our content, be sure to check out our full content library at gems.closingbell.co.
I thought maybe we could get started by you just giving us the ABCs of Vince, talk about your background, some highlights, and then Nathan will take you into some other more personal questions just to get your understanding, an understanding of how you trade, how you invest, and a couple of fun questions as well. So maybe we can start with ABCs of Vince and we'll get started.
Certainly, yeah. It's investing is, I'm one of those investors kind of always enjoyed it as a kid, and my father was in the industry. My direct experience is pretty thin, actually. I took a job at a broker in Manhattan in 1999, which the brokerage rode the dot-com bubble up to the 2000 peak. And then I think by about mid-2001, they were out of business and I'd been laid off before they even got to that point. But I've been writing about the market for well over a decade now, several different sites, been investing for 20 years or more than 20 years now, unfortunately. So it's always been a passion and always been something that there are I believe very few subjects in this world that are as fascinating, as constantly changing, have so many variables, that have so many interpretations. That's, I think, one of the really joyful things about investing is two very good investors who really do the work, who are experienced and intelligent, can look at the same stock and have diametrically opposite conclusions. And as the saying goes, that's what makes it market. But I think that's also what makes it fun to write about, what makes it fun to put into practice.
Yeah, fantastic. Thanks for the intro, Vince. And as Lucas said, it's a pleasure to have you on. We do like to do things a little bit differently before we jump into the macro-related stuff and then the stock-specific questions. So there's a little kind of role-playing game that we'll start with. I'm not sure if you played this one, but the rules are pretty simple. You've got to assign one of the three roles to these three people. So each person has to have a role. The roles are friend, marry, kill. And the people are Albert Bourla, I probably pronounced that wrong, Chief Executive Officer at Pfizer, Brian McNamara, CEO of Haleon, and Anthony Fauci, who was the chief medical advisor. So a friend, a marry, a kill to those three people.
Oh man. I think I have to say friend for Fauci because you gotta, his political reputation is such that I gotta kind of go right down the middle, right? I can't pick one or the other. I'm going to get somebody mad at me.
It's a bit of a stitching, but
so I guess I have to go friend Fauci. I'll marry McNamara because I think he's gonna do well, and I'll kill Albert, whose last name is escaping me at the moment. But
yeah,
I will kill him reluctantly. We'll put it that way.
Perfect. No, that was it. I'm thankful that you participated. Yeah, a controversial participation. I'm glad that you got through it. Now, Joe wrote an interesting piece recently on the 6 investing lessons that you wished you learned. Like all investors early in their careers, probably for a lot of the listeners, you mentioned you racked up a number of mistakes, which cost you a lot of money. I was keen to get your kind of top 2 lessons that would resonate with our listeners that you may have experienced early in your career.
Well, number one with the bullet, as we say here, is what's known as anchoring bias. The idea that if a stock's down big, well, now it's cheap, it's down 90%. I think in this market in particular, that's particularly dangerous. But somebody who was putting money in like 2001 and the aftermath of the dot-com bubble, I still remember Metro Media Fiber Networks, which was down, I'm sure 98%, and it had been at 200, and it was only at 3, and oh man, it can't be right. I mean, it's got to be a buy that, and it was at 0 like 6 months later. So that's the one that certainly sticks with me. Number two, I think the second one would be to try and stay in your lane. And I don't mean that to be quite as condescending as it might sound at first. Just I think it's impossible to kind of entangle your personality from your investing style. And if you want to be an aggressive investor, you can do that in the right way. But if you're kind of a conservative person, or you know, you have different goals, saying, "Oh, I want to be an aggressive investor," like doesn't work. Like I think trying to match your investing style to your personality is helpful, because again, at the beginning, I was there at a time when these big growth trends and stuff were kind of hot, and that was something that I got sucked into, even though I don't think that's really, certainly not where my taste for, ran later, when I think I got more experience and more success, and a better, uh, a better process.
Yeah, no, I think that's terrific lesson.
Yeah. Good.
Go for it, Luca.
Yeah. Great pieces of advice. Yeah, Nathan, I'll just get you on mute quickly, Nathan. Awesome. Now, Vince, you have a funny writing style. You make me laugh sometimes when you write. And one of the pieces you recently wrote was Shitco's Revisited. And I had a great time going through that. Now, a couple of companies that you wrote about, you mentioned Carvana, Beyond Meat, Heron Therapeutics, Wayfair, Fubo TV, Lemonade. I have a gripe with Lemonade because they bought Metro Mile, and I invested in one of Chamat's shit stocks. So that's another shit code that you can add to the list. Now you mentioned the average return of these 8 stocks has been 45% over the same stretch. The S&P 500 has gained 3%, and the Russell 2000 6.5%. Can you talk about what's happening, particularly over the last couple of months? Since July 2nd is the kind of the time frame that you used in that article.
I think that's right. I mean, what we had, kind of from about early July, was a very broad rally in stocks that, generally speaking, that had been the biggest decliners from their highs, and in a lot of, sometimes that was late 2021 highs. In the case of some of those other names, it was February 2021 highs. But that article was about that rally, and it was a very, very steep. And of course, I mean, if anyone paying attention to the market the last couple of weeks, we've seen a little bit of the meme stock come back. Bed Bath and Beyond getting a lot of attention over the last couple of weeks. But it's really kind of just beyond that. It's really been the stocks that were really hammered the most. Starting in July, saw a very steep, and again, relatively broad rebound. You mentioned those 8 names, but we also point out in the piece that so-called de-SPACs, companies that went public via SPAC mergers. We've talked about those on the site a couple times, and we have a sheet of, I think it's 290 of them. They were up 20. I mean, that entire group is up 20% in a month. Any trend that's moving almost 300 stocks, 20% in 5 weeks or 4 weeks, whatever the actual number was, that's a really big, it doesn't just happen, a couple times a year. That's a pretty significant move. So yeah, it was very interesting. I think it's actually petering out a little bit in recent sessions. We might have kind of written about it right at the peak. But even so, a lot of those names are up quite a bit from the bottom.
Yeah. Do you think that in this age of information where you have, companies like Robinhood, you have Reddit, Wall Street Bets, people are so locked in all the time. Do you think that the cycles, the bear and bull sort of market cycles, are going to start moving faster, or are moving faster than they would in the past? Like in the past, they might take a couple of years to rebound, but now we're seeing things go up and down so quickly, particularly with COVID. Things ramped up, then things dropped fast, and now it looks like things might start to recover. Do you have a view on that, or do you think this is just playing out the way it would always play out?
Well, that's a fascinating question. That truthfully, I don't know that I'd really thought through that. I think you could certainly argue in those kind of names that there's probably some truth to that. I don't think it's going to be true for the market as a whole, simply because if you're talking about, let's say, the S&P 500, the investor base kind of really hasn't changed all that much. I mean, there are Robinhood investors who own S&P 500 companies, but they're not, there's probably this, someone who owns Pfizer. Oh, that's probably a bad example in the COVID age, but somebody who owns Illinois Toolworks via Robinhood in 2022, they're probably the same kind of retail investor who might have owned it in 2017 via Charles Schwab or whoever. But yeah, I mean, I think certainly in the names that Robinhood investors, that retail investors like, yeah, I think you're certainly going to see more volatility, because it's pretty clear in a lot of these names that there's, and I don't necessarily mean this purely as criticism, but they're not always investors, and they're not always, the people riding Bed Bath & Beyond from 5 to 20 are not. They're not looking at it saying, well, the higher stock price means they can do an offering, which may improve the balance. I mean, they're not doing that. It's a short squeeze. Oh, it's going up. Oh, I think for some investors, it's fun. I don't know that I'm necessarily going to disagree with that. I mean, when you wake up in the morning and you have a good idea the stock's going to move 30%, you don't know which way. That's probably more exciting than owning Illinois Toolworks. So, but yeah, it's an interesting question in terms of cycles, and I think in terms of volatility. And I would think the answer is probably to some degree, yes, that's true. How much? I'm not smart enough to know, and I don't know if someone smarter than me, how they could parse that out. But yeah, I mean, it certainly seems that way. It's been a wild, I mean, it's 2.5 years now. Much. And you think about the 2.5 years from February 2020 going back, we had like this little scare in the fourth quarter of 2018, and it ended, it lasted a couple months. But other than that, it was just sort of like, it was just the stock market. Nothing was really going on. And in the last 30 months have been, I mean, there's big stories happening every month, it seems like.
Yeah, 100%. And I think to your point about it being fun, it feels like trading in particular over the last 30 months it's like Vegas online. And everyone's sort of jumping in there, and they're not letting it go. When it goes down, people jump in. I think eventually there'll be like a law of averages effect that happens, and people get wiped out because you trade too much. I think a stat that E-Trade did on their traders and their platform was that when people trade stocks, 80% of them end up losing money. And that can only go on for so long before people get upset with trading and don't have a good experience. And so then what's left over are sort of longer term investors, I think. But as you said, if you're not smart enough, I'm definitely not smart enough to have commentary on.
Yeah, I mean, I think that
on that
is, because I think the zero commission nature of trading nowadays leads investors to believe that there's no cost to trading, but of course it's not true. There's spreads and things like that. And I know I looked at Robinhood last year, and I can't remember the exact number, but I think even in their equity side, it seemed like their revenue was something like 3% of client assets in a quarter, just in terms of equities. So if you're saying like they're like all else equal, they're 3% of their customers' portfolios are getting eaten up by trading. And you say for the people who are really trading, the figure's probably 8, 9, 10%. That's just a huge headwind that if you're not professional, you're going to get wiped out. And it's just a matter of time. You're going to have some peaks and valleys, and there'll be days when you think you're really good at it. And, but that's, it's, to your point, it's like gambling. It's like betting against the house or whatever. In blackjack, the house generally wins over time, if you're playing that much.
Exactly. Now, just switching gears slightly to Haleon. So, good. So, just switching gears to Haleon slightly. Mid 2019, Pfizer and GSK get together, do a joint venture for a healthcare business, consumer healthcare business. 2 years later, GSK officially announced that it would spin off the JV. The spin-off named Haleon closed in July 18th of this year. So 3 days after my birthday, very special date. Can you talk to us what happened? So explain what happened, what Haleon does, and then we'll talk about the case, the bull and bear case for Haleon right after.
So, like I said, Haleon was spun out of those two companies. It was a combination of their consumer health businesses. So they, in the U.S., their products are known as they're known over the counter worldwide. In the U.S., you can buy them in pharmacies, but also mass, Walmarts, grocery stores, things like that. In a lot of European countries, because of regulations, you don't need a prescription, but you still have to buy them in a pharmacy. But they're big brands. Panadol, which is a Tylenol competitor. They own Advil, Theraflu, Polydent, which is Polydent is Venture Care, things like that. So they have 9 brands that they call power brands, worldwide sales. You can think of them, it's an imperfect analogy, but you can think of them sort of as a Procter and Gamble on the healthcare business, in terms of having that kind of reach, brands across multiple categories. And they're not nearly as big or as profitable as Procter and Gamble, but it's a similar business model and a similar business profile, so to speak. So they were, like you said, they were spun off last month. And the reason for the spinoff, the core reason for the spinoff is basically GSK and Pfizer, just like the other pharmaceuticals, they really want to just be in pharmaceuticals. And there's the idea that if you take them out of, they're not run by pharmaceutical executives, they're run by consumer executives, you're going to have better performance, et cetera, et cetera. And the spinoff was people kind of shrugged. The spinoff didn't do much. And then about 3 weeks ago now, the stock just fell off a cliff. And the reason for that seems to be that investors suddenly realized that a heartburn treatment called Zantac was pulled off the shelves in the US and the EU in recent years, that there was legal liability that Haleon could have had exposure to. But as I wrote in the piece, that explanation is kind of the most logical explanation, but it's not really that logical, because GSK had talked about this when the JV was still part of their business. Haleon had discussed it at length in their filings. Haleon has had an investor day with multiple analysts there asking questions, and none of the analysts really seem to care. It is one of the stranger things I've seen. I don't think it's nefarious or anything like that. It's just weird that you have this liability, which has taken, what time I wrote, I haven't looked at the stock today, but it's taken $6 or $7 billion off their market cap. That just sort of like nothing changed. It just seems like everybody just woke up one day and was like, oh, wait a minute. This is weird. And then once somebody told someone, and next thing you know, the stock's down 20%. So it's one of the I guess it was 2018. It would be a weird story. By 2022 standards, it's not that weird. it's a little.
Yeah, well, it's I was just looking at the stock now. So I think it's down 15% since it went public, and it's up 5% over the last 5 days. So maybe the narrative's changing slightly.
Yeah, I think, okay. Yeah, I know it bounced kind of nicely yesterday. So
Yeah. Thought we could also just talk through the bullish case, because I know in your recent article you mentioned specifically that you think it is a truly attractive business. So just maybe for the listeners, run through what the bull case looks like, the stock and the business.
yeah, I mean, I think if you're talking from a business perspective, again, I think the Procter and Gamble comparison has some validity. They have that kind of reach, they have that kind of scale. They have number one market share in the U.S. They're number two in China. They're number two market share in China. They're number one non-Chinese firm. A lot of different brands. That scale is just really, really important. We've seen that over and over again in consumer packaged goods companies like this. So just from that perspective, it is a business that you want to own. It's defensive. We will probably, if we want to talk about the bear case, we can maybe quibble with the term defensive, but certainly people are going to use Advil if they have a headache. That's not something that they're necessarily going to cut back on. And like I said, it's well scaled, and I'm missing one point. the other, it's exceptionally profitable. They have huge, very high profit margins. So it's just if you look at it fundamentally, if you didn't know, if for some reason, if you looked at it not knowing about the Zantac issue, you would just be like, this is insane. Something's really, really wrong. This almost literally doesn't make sense that this business is trading at, I think it's about now, with the bounce 15 times earnings, even, they took on debt as part of the spinoff. So they have to pay interest on that. Even if you add that back, they're still at about 15 times earnings, which is, way, way too low for this kind of business.
Yeah. Is Zantac the only kind of bear scenario or issue with Haleon, or are there other factors playing in that you think could be problematic over the medium term?
Yeah. To the point about whether it's defensive or not, I think that would be, that kind of gets to probably the heart of your bull case. They get about over 40% of the profit comes from Europe. I think investors are pretty rightly worried about having exposure to Europe, given what's going on with energy prices there. And so one of the bearish concerns would be, if things get bad or if they stay bad, well, I mean, Advil might be a great brand, but they're going to go get the generic because they're just literally not going to have a choice, or they're going to be looking to pinch pennies wherever they can. So that, I think that's kind of one of the really core issues. And then I think the second core issue is that it's not a growth business. They grow pretty well for what they are. They're saying that they're going to grow revenue 4 to 6%, but it's, when you have, particularly they have an indebted balance sheet after the spin, about 4 times EBITDA. So which is high for that kind of business. So if growth, what you worry about, I think, is you get some switching down in a private label or lower price competition. You get some margin compression because they either have to cut prices or lose sales. And then you amplify that with a balance sheet, earnings stop. And, when you have an indebted balance sheet and your earnings stop growing, it can get ugly and hurt. I think that's the core of your bear case there.
Yeah. Does Haleon compete with, I'm not sure how big Mark Cuban's Cost Plus company is, the Cost Plus Drugs pharmaceutical business he started. Do you know much about that business, and whether you think that can?
To be honest, I know I think I know enough to write a tweet. I know 280 characters.
Me.
But no, they wouldn't compete because Haleon it's not prescription. That's right. Because I think Cuban's business is is doing prescription drugs. They're doing generic prescription drugs, which is where the patent, you still have to have a prescription to get those drugs. Haleon, all their revenue stream is non-prescription.
Yep, over the counter stuff. To pivot slightly, are there any stocks that you're looking at right now that really interest you, that really capture your attention, that maybe you're writing a report on or you're doing some research on, that we could share with the listeners?
Oh boy, that's a good question. Yeah, I'll be honest right now. It's really tough to, I can't remember a time where it's harder to really feel like an idea is compelling. I really like the long case for Haleon here. I think that's just a mispricing. But there are just so many uncertainties, macroeconomics, valuation, short-term trading. Is this a bear market rally as the bottom end? I find myself looking at stocks and just sort of being like, well, yeah, that looks nice, but yeah, I'm trying to think of some of the names that have jumped out that we haven't covered of late, from the long side. One that I like that I actually own in my personal account is a company called Bluebird, and they're a school bus operator in the U.S. and Canada. They got real hot last year because, like every other automotive manufacturer, they're moving into electric versions. And that when investors liked electric vehicles last year, the stock went up, and then investors don't like electric vehicles anymore, and the stock went down. But I think that's just, and then they've had problems with inflation. They have had problems with their supply chain, which have actually doubled up because their last quarter earnings were awful because they agreed to pricing last year, but by the time they actually got the parts to make the bus that they were delivering in 9-10 months had gone by, the costs had all soared, but they decided to keep their old pricing to keep their customers. So I think that's one that I really like, just because it looks so bad right now. Everything looks like it's going wrong, that I think that's kind of where you have an opportunity if what's going wrong is fixable and or temporary. And I think over time that they're going to be in good shape. I have no idea what stock's going to do in the next 3-6 months. Its next quarter earnings might not be any better. That's kind of one where I have in the portfolio, and unless something really goes sideways, it's going to be in a portfolio 3 years from now, I would assume. And it might take that long.
Yep. You mentioned the macroeconomic. Oh, yeah. Yeah, understood. You mentioned, and just before we wrap up here, you mentioned the macroeconomic issues playing a part in your understanding of what stocks are out there. And I thought maybe you could talk to us about like maybe one or two of your top concerns, because we're not based in the States, so we don't get a sort of touch and feel for what's happening over there. Obviously, it's a very volatile environment, but are there two or three things maybe that stand out to you as being problematic in the macroeconomic environment that's stopping you from buying or stopping you from seeing good opportunities?
Yeah, I don't know. It's necessarily stopping me from buying as much as it is. It's just unsettling, because I think the core of it is, if you tell me that company X made $100 million in net profit over the last 12 months, I have absolutely no idea whether that's better than norm. Like, is the environment that they operated in, is that better than normal? Is that better than it's going to be? Is it worse? There are just so many moving parts. I mean, you look at U.S. retailers, and the little bit I've seen, I know this is true elsewhere too, where you say, they had a huge year last year and then a bad year this year. Is that inflation in the economy? Is it because people just bought, like maybe I'm probably including that, people just bought too much stuff last year because we didn't really have anything else to do. So I think broadly, I'm not necessarily that bearish on it. It's just really hard on an individual company level to try and just understand all the cross currents. I will say for U.S. companies, I think my broad concern, which I mentioned with Haleon, is I think Europe is huge concern, both because so many U.S. companies have exposure to Europe, which they're facing the problem of it's going to be a really bad winter there in terms of energy costs, and this dollar has strengthened so much that that's another headwind. It helps local competitors. And B, I do wonder in the States if we're talking about inflation and the Federal Reserve, and are they going to raise 50 basis points or 75 basis points? And I don't know that I'm not like convinced this is the case, but I think if the market's missing something right now, I think the most likely thing that it's missing is it's looking at that stuff and it's ignoring energy crisis in Europe. It's ignoring a property bubble in China, which appears to be imploding. It's ignoring risks in developing markets in terms of political upheaval, Sri Lanka. There's a couple of countries in Latin America that have some goofy things going on. What worries me about the American economy is not. I think our economy is fine right now. What worries me is all that stuff kind of happens, and just the way the world economy works, the way our economy works, and particularly the way our large corporations work, we're not going to be immune to that. It's not just going to be like, oh, well, we have plentiful natural gas. Our energy bills aren't going to go up as much as Europe. So that's their problem. Nothing in this world anymore is their problem, economically speaking. So that's, I think, if you wanted me to kind of say where I see the biggest risk, I think that's it in a midterm standpoint, from a midterm perspective.
Awesome. It's been terrific to have you on, Vince. Fascinating business case. I think the listeners will get a lot out of it.